Hello everyone and welcome to the LM Report. I'm your host, Lima, and this is episode 14A, recorded on April 17, 2025. Today, we're exploring how tariffs are reshaping global trade, the push for U.S. economic independence, and the Federal Reserve's role in this evolving landscape. We'll also discuss why these changes matter for jobs, prices, and your wallet. Let's dive into the economic news. Tariffs and global trade dynamics. President Trump's administration is using tariffs as a tool to renegotiate trade relationships and boost U.S. manufacturing. These tariffs target countries with significant trade surpluses, like China and parts of the European Union. The strategy is straightforward. Impose tariffs to raise the cost of imports, encouraging companies to produce in the U.S. and prompting nations to negotiate fairer trade deals. A recent EU study estimates that these tariffs could cost the bloc $1.25 trillion over 4 years if no agreement is reached. This financial pressure is pushing EU leaders to consider negotiations to avoid export losses and factory closures. Manufacturers, facing billions in added costs, may relocate to the U.S. to bypass tariffs, especially as domestic energy prices drop and regulations ease. Meanwhile, countries like Mexico, Japan, and Italy are engaging in trade talks. Japan, for instance, proposed $300 billion in U.S. investments and military cooperation to ease tariff tensions. These talks blend trade fairness with strategic alliances, potentially setting a precedent for deals with South Korea or the EU. The White House sees Japan as a test case for this approach. This strategy isolates nations hesitant to negotiate, like China. By securing deals with allies, the U.S. strengthens its leverage, potentially forcing China to the table. Trump recently stated, "We're going to make a very good deal with China eventually," signaling confidence in this approach. However, critics warn that tariffs could raise consumer prices if costs are passed on, though supporters argue that energy savings and tax cuts will offset this. Energy, technology, and economic independence. A key pillar of this economic plan is reducing U.S. reliance on foreign resources. A recent presidential memorandum aims to modernize federal permitting for infrastructure projects, from drilling to mining to tech manufacturing. By digitizing applications and cutting red tape, the administration hopes to expedite projects, making the U.S. a hub for energy and technology production. This push for energy dominance is already impacting prices. Oil prices are stabilizing due to increased domestic production and OPEC's higher output. Lower energy costs reduce expenses for households, businesses, and manufacturers, which could counteract tariff-related price hikes. For example, cheaper fuel lowers shipping costs, potentially reducing prices at stores. Technology is another focus. By streamlining permits for tech manufacturing, the U.S. aims to bring production home. This could create jobs and position the country as a global tech leader, exporting innovations worldwide. The goal is clear: an independent U.S. that drills, mines, builds, and innovates faster than its competitors, reducing dependence on foreign supply chains. This approach isn't without risks. Environmental groups argue that expedited permitting could harm ecosystems, while some economists worry about trade disruptions. Yet, the administration counters that innovation and efficiency will drive cleaner, more reliable growth, benefiting both the economy and the environment. The Federal Reserve under scrutiny. Now, let's turn to the Federal Reserve, which is facing a spotlight as economic conditions shift. The Fed's decisions on interest rates hinge on data like inflation and unemployment. With inflation cooling, recent reports show near-zero inflation for March 2025, and job creation rising, the Fed is under pressure to lower rates to stimulate borrowing and investment. However, Fed officials are cautious, citing potential inflation risks from tariffs. They're reluctant to cut rates quickly, fearing it could undo years of work stabilizing prices since 2022. This hesitation echoes 2018 to 2019, when the Fed raised rates despite low inflation and unemployment, a move critics argued slowed growth. The administration is highlighting this disconnect. Trump recently noted that the European Central Bank is cutting rates for the 7th time, while the Fed lags. He's called for lower rates, arguing that falling oil prices, cheaper groceries, and tariff revenues are strengthening the economy. This public pressure aims to align Fed policy with current data, though some, like Senator Elizabeth Warren, argue it threatens the Fed's independence. Warren herself, alongside other Democrats, urged the Fed to cut rates by 75 basis points in September 2024, highlighting the complexity of these debates. The Fed's challenge is balancing independence with economic realities. If inflation and unemployment remain low, rate cuts may become inevitable, supporting growth without overheating the economy. Tax reforms and buying power. Tax policy is another driver of this economic shift. The administration is proposing to eliminate taxes on tips, Social Security, and overtime, aiming to boost workers' disposable income. These cuts are funded by tariff revenues, energy sales, and technology exports, reducing reliance on individual taxes. This approach could transform household finances. For example, removing taxes on overtime encourages workers to earn more without losing income to taxes. Similarly, untaxed tips benefit service workers, while Social Security tax relief supports retirees. As tariff revenues grow, the administration may expand these cuts, potentially for households earning $150,000 or less, enhancing buying power. The long-term vision is an external revenue service, where tariffs and exports replace income taxes. This aligns with constitutional principles of minimizing direct taxation, giving workers more control over their earnings. Critics warn that tariff reliance could falter if trade deals falter, but supporters see it as a path to economic freedom. Sound money and economic future. Finally, let's discuss sound money. Rising gold prices, now over $3,200 per ounce, reflect investor demand for tangible assets amid uncertainty about fiat currencies. Some see this as a critique of the Fed system, where money supply growth can devalue currency. While a return to the gold standard is speculative, it's a topic gaining traction. The administration's focus on tariffs, energy, and manufacturing aims to reduce dependence on borrowing, potentially challenging the Fed's role. An audit of federal debt, as some propose, could reveal inefficiencies or fraud, reshaping how we view the $36 trillion national debt. If debt obligations shrink, so could the need for taxes or borrowing, paving the way for sound money systems like gold or digital currencies. Challenges remain. Global competitors may resist trade shifts, and the Fed could push back to maintain influence. Yet, if jobs grow, prices stabilize, and buying power returns, public support for these reforms could solidify, driving a new era of economic independence. That's all for today's LM report. Thanks for joining me as we unpack tariffs, trade, and the path to economic independence. If you found this episode valuable, please subscribe to our channel for daily insights on global markets and policies. Hit the bell icon to stay updated, and share your thoughts in the comments. I'm Lima, and I'll see you next time. Stay informed, stay curious, and take care.